Hi everyone, welcome to another episode of Talk to C. Recently, I finished reading Barbarians at the Gate, which is a very thick book, but interesting book about one of the most famous LBOs in history. It's actually the third largest one, in which KKR, one of the biggest private equity firms led by Henry Kravis, bought out RJR Nabisco. You might know Nabisco from the Oreos, the little logo that you see in the Oreos, for $25.1 billion. Just insane, and that was in 1988, so imagine with inflation what the number would be today. But it's a story that if you're into finance, you should definitely know. But if you're not into finance, I thought I'd make this quick video to explain what an LBO really is and how they work. So what is an LBO? An LBO is a leveraged buyout. It can either be done by a private equity firm or by management. If it's done by management, it's called an MBO, a management buyout. Pretty simple. Think of an LBO like buying a house. The firm that wants to acquire another company puts down 25 to 50% and borrows 55 to 75%. So let's say, for example, a company wants to buy a $10 billion company. They put down $2.5 billion and they borrow the other $7.5 billion from other institutions. And that way they can acquire huge companies with a little amount of money. So in summary, a private equity firm, management, or whoever wants to engage in an LBO buys a company with borrowed money. They take it private if it's public. They operate it for 5 to 6 years, and then they sell it for a huge profit, most of the times. So a question you might have is, what do firms look for in a target? In other words, in a company that they want to buy. There's obviously more, but I'm going to mention 4 key things. First one, companies with low leverage. This means companies that have low levels of debt so that the debt they take out can be put in their balance sheet. Something I didn't mention is that the company that's buying the target firm takes out debt and puts the company as collateral, and they're going to use the cash flows from the company to pay that debt. Secondly, obviously they want to get a company with a fair valuation. Nowadays, with the stock market the way it is, even though it's been crashing for the past 2 weeks, some companies have insane valuations with insane PE multiples that really don't make sense. When you look for a company to buy, you really want to get a good deal because you want to flip it within 5 years. The third thing they look for is for a company that has some room when it comes to costs. For a leveraged buyout to work, you need to find a company that has potential for cost cutting. The last thing you need is a company with consistent cash flows. You're gonna put a huge debt on the balance sheet that's gonna charge interest every year or whatever the terms are. So you wanna make sure the company's able to pay that debt so you don't lose the company. You normally wouldn't want a company that's just starting to make cash and you don't know what the cash flow projection for the next few years are. So the buyer normally focuses on companies that have existed for a while and that they know they can get a certain amount of cash flows every month or every year. Now we can shift to how do private equity firms, management, or other companies create value with a leveraged buyout. There's been a lot of criticism in the past. They mention it in the book Barbarians at the Gate because they say that buyers that use leverage only care about the profit. They don't care about the people in the company. They don't care about whether the company works or not after they sell it. They only care about the quick flip, the quick profit, and that's it. But to be fair, there are some ways that you can bring value with a leveraged buyout. First are the tax benefits. When you take out such a huge loan, you're gonna pay a lot of interest, and in many cases, all of that interest or part of that interest can be deducted as an expense. So obviously, that lowers your tax bills. Secondly, you avoid the accounting costs, other costs, and the pressures in general of being public. Public companies have a lot of pressure to file, to impress shareholders, and by taking a company private, you can shift the focus from a short-term, make the shareholders happy focus to a more long-term view of the company. Lastly, that puts pressure on management to really tighten up the operations of the company because they have to pay it. If not, they lose the company. All the jets, all the fancy stuff sometimes has to go because you have to pay a debt. And there's times that the private equity firms or whoever the buyer is puts 2 or 3 people on the board so they make sure they can really tighten up the cost and get the profits up. But those are more qualitative characteristics of an LBO. And I wanted to show you guys, because I learned better with examples, I wanted to show you what an LBO looks like quantitatively. So for this example, imagine a company that makes $100 million free cash flow. I'll put the formula here so you know what free cash flow is. Every year for the next 5 years, and a tax rate of 40%. Obviously here in the US it's 21%, but let's use 40% for now. Let's say the total purchase price was $700 million. You put $200 million of equity, in other words, of your own money, and you took out 2 kinds of debt, senior debt and junior debt. You have to pay the senior debt first before you can pay the junior debt. The senior debt is gonna charge you 5% interest per year, and the junior debt is going to charge you 10% interest per year. Now let's go to my iPad so you guys see more or less how an LBO works. So here we have the free cash flow, 5 years, 100 million, like we mentioned before. We have the senior debt, which is 200 million, and the junior debt, which is 300 million. And we have the after-tax interest expense. After tax because you're saving, because interest is an expense. So you pay less taxes thanks to that expense. So the senior debt is going to be at 5% interest rate and the junior debt is going to be at 10%. The way we calculate the interest expense is we get the yearly interest expense, which is going to be easy. It's going to be 200 times 0.05, which quick maths is equal to 10. But then we have to multiply that times the tax savings that we're getting because of the expense. And the way you do that is that you get 10 times 1 minus 0.40, which is the tax rate that we set in this example. And if you do the math, this would give you an interest expense of 6 million. Let me erase all this. This would give you an interest expense of 6 million. Then for the junior debt, we're gonna do 300 times 10%. It's gonna be 30 million. But we have to get the tax savings, which is going to be 1 minus 40, and that would be 18. So then you get the free cash flow, subtract 6, subtract 18, and that would give you a total of 76 million left over. So with this leftover cash, it depends what you want to do. You can either reinvest it in the business, so hopefully in the next years you produce more cash. But in this case, we're just going to pay down the debt. So 200 minus 76 is equal to 124. For year 2, you would calculate 124 times 5% times the tax savings. And you can do that for all the other years. And that way you can track more or less your cash flows and if you can pay the debt, which in this case you easily can with the cash flows you're getting. And then if you have an exit after 5 years, you can calculate your rate of return by getting the IRR, which is the internal rate of return. And the formula I used in my college classes is the selling price divided by the initial investment to the power of 1 over T, which is time. So in this case, we held the company for 5 years. T would be 5. And that way you get the final rate of return. So here you have it, easy way to track the debt payments and the rate of return. So hopefully that's helpful. That's more or less how an LBO works. If you like this video, drop a like, subscribe. I might do another video in the future explaining how companies can defend themselves from a hostile takeover, which I think is pretty cool. If you enjoyed this topic, I definitely recommend you guys reading Barbarians at the Gate. It's a great book that goes more into details about how an LBO works, all the negotiations, all the talks, all the moves that you can use in order to win an LBO. And let me know if you have any questions. I'll see you next Wednesday at 5 p.m. like always. Peace.